Kieran Gallagher, Regional Product Director at Vitol, Bahrain. The big part of this narrative, Kieran, of course, is where is diesel given its it's very elevated prices, the shortages that are appearing, the dislocations. How do you see diesel's role and where its market will go vis-a-vis the Russian disruption, if you like?
Yeah, good morning, Sean. Good morning, Claudia Daly. It's obviously a very interesting one with diesel, and I do think we'll see a change of flows over time. Maybe that's started already. But we came into this Russian-Ukraine conflict in an already very tight middle distillate market. So the move on diesel has been exacerbated somewhat because of the sheer volume of exports that Russia gives to the European market in particular. I think at the moment, obviously, much of Western Europe is still taking Russian oil. Yes, there's some self-sanctioning going on, and therefore the real impact hasn't hit yet. It's also offset somewhat by the current situation in China, where we very much are seeing stock building and obviously lower demand because of the current COVID situation. So I think there's an argument to say, well, we haven't seen the full impact of this yet. I think we're continuing to see across the world gas to oil switching and therefore very, very healthy diesel demand in non-traditional sectors. So how do I see it playing out? I think there is going to be a change of flows that Russian oil could point to different areas. But as Clyde pointed to on the crude front, the buyers for the Russian material might be Asian buyers. A lot of the Indian refiners are already net exporters of diesel, so they're not markets that this flow can traditionally go to. Perhaps Latin America, perhaps a little bit of West Africa, etc. But certainly we see problematic future on the diesel front for if this continues.
And Kieran, if we take the obviously all of these things are about timing, right? We're into the second quarter now. The Russian disruption, as you highlight, hasn't really happened yet, right? The export 5 million barrels of crude a day, 2 million barrels of product. Everything was pretty much on schedule for month of March. As we go into the second quarter, the end of winter, the start of the driving season, if you like, vis-a-vis the US high demand, time of year, how does that play in, do you think, where that collides with the Russian disruption?
Well, I think we're seeing, particularly in Europe and North America at the moment, a massive fight for yield in the refining system. And I think that's been exacerbated this week a lot between jet fuel and gas oil. Jet fuel in New York Harbor hit $320 a barrel this week, which is absolutely record for a physical barge trade. And therefore, you see it already where jet fuel production has suffered at the hands of the need for diesel. Then, as you say, we're moving into driving season, particularly in the US, where that need for gasoline is there, and that will indeed eat into diesel production. So I think we're going to see a real fight for yield continuing, perhaps in the US more than other countries.
Coming back to the emerging, as we've just sort of highlighted in our first comments round, is the idea that this dislocation, the flow disruption, is going to start to trickle through. We're seeing reports out of Kenya where there is logistics disruption to middle distillates. We're seeing also the World Bank forecasting that there could be economic slowdown. How do you think the dislocation from flow, where does Europe get its middle distillates if it stops taking Russian diesel starts getting disrupted? Where do you think that disruption comes into play most profoundly? Obviously, Africa would feel the heat of a lot of this.
Well, I think the east coast of Africa and indeed South Africa are currently feeling a few repercussions from government intervention from the initial supply shock, and therefore, where there was duty rebates to importers, etc., and I think in the case of Kenya, those duty rebates aren't getting paid immediately, and therefore the next round of imports, the importers are struggling. And therefore you're getting queues at the pumps. Small independent retailers actually can't afford to import, and they become wholesalers. So there's some knock-on effects from these duty rebates. I think just in the last 48 hours, South Africa have also announced a new system of rebating duty to importers, and that's also going to cause some speed bumps with regard to supply down to the wholesalers. So there's that element. Separately, the second part of your question, where does it feed in from Europe? I think what we did see 3 weeks ago was a massively open arbitrage from the Middle East to Europe. So if you take the let's say regional demand of say diesel per se out of it on the East, Middle East, Pakistan, etc. like that, and you say, well, there's roughly 3 million tons a month there to go east or west. And we've seen at the beginning of this year, perhaps just over 1 million tons of that AG and Indian diesel going east. Around 3 weeks ago, there was an open arb. The east-west was minus $160 a ton. Everything pointed west, and indeed, you could argue that whatever 2.5 million tons of that excess flow can go to Europe. So Europe can get covered here. I think that's one thing.
If they're willing to pay the premium that Asia has always paid.
Exactly, Sean. That's exactly it, and therefore it's the actual premium that is going to this is going to be reflected in. And then you've got effectively two different pricing centers pooling for the same oil, and that's currently been reflected in the FOB premium that you're seeing paid for diesel in the Middle East at the moment, where a 10 ppm cargo is trading north of $7 a barrel versus a term price for 2022 around $1.50.
Kieran, of course, as an integral part of the physical distribution of these crude and products in the world, Vitol and all of its peer group are in the center of that. How difficult is it, I mean, just to address the point that Clyde just made there, I mean, there might be Russian oil inside my diesel or inside my whatever. For you and your peer group, how much of a burden is this on you to be the policeman, or do you abstain from that position and whatever's legal is legal, whatever isn't? How do you navigate that?
No, I don't think you can abstain. I think there's a huge amount of dialogue going on, whether it be with governments, with our receiving customers, with our suppliers, etc. like that. Our compliance team are intricate in this dialogue as well. So no, at every sort of facet of our business, because this conversation is part of every product trade at the moment, Sean. There's no getting away from it, and it could be, as Clyde alluded to, maybe a Japan to Australia trade. But there is a contractual wording with regard to sanctions clauses, etc., that come into these deals now, just so that everyone is on the one page. So no, there's dialogue, as I said, at every facet of the business, and we just have to devote that time as we really are doing.
And is this a period, I mean, obviously the nature of your business and the nature of this space is that there's always something, right? We've had Iran sanctions, Venezuela, there's wars, there's all sorts of reasons why this is a complicated space. Is this much more profound than others, would you say, from that point of view?
You would say it is, because just the sheer volume of energy exports that Russia currently supplies to the world. So yes, with Iran it was more localized and largely crude going to refiners, etc. like that. With Venezuela as well, it was largely based around the Gulf Coast market and the US. So no, this has a much broader impact for sure.
And when you take that point, I mean, vis-a-vis the kind of ripples on this challenge is the insurance premiums associated with Russian waters and shipping, and then the Black Sea having it would be reported, mines potentially and so forth. That sort of physical disruption and obviously the price vis-a-vis insurance, is that a structural challenge that has yet to play out in this equation as well?
Again, I think it plays out in the actual delivered price of the oil, etc., like that. I think in the early stages of the conflict, when there was such uncertainty around this, we were seeing some ship owners quote up to $200,000 for the war risk to enter the Black Sea. It didn't matter if it was going to a Russian port or any other port. It was just to go into that Black Sea. I think that's stabilized somewhat now, but what we are seeing, as you alluded to there, is a sort of ever decreasing fleet of owners of physical vessels willing to call to Black Sea ports.